Alright guys, welcome back to the channel. Today we're breaking down one of the most important ICT concept, liquidity. By the end of this video, you'll know what liquidity means, why price hunts all highs and all lows, the difference between high risk and liquidity runs and low risk and liquidity runs, and how to identify easiest market conditions to trade. Right? So let's get into it. And what is liquidity? Liquidity simply refers to how easily an asset can be bought or sold without causing huge price change, you could say. But in ICT concept, we focus on liquidity as resting orders in the marketplace, like buy stop above old highs and sell stop below old lows. Every old high has buy stops above it, and every low has sell stop below that. So whenever price runs for these highs, they are going there to take out those buy stops and sell stops. All right. Now, why there are buy stops out of these old highs and sell stop below these old lows, right? Imagine one went short here at that very high, right? He's gonna put his stop loss somewhere above that high, right? So that's gonna become buy stops, and same goes for sell stops. Like if someone went long here, he's gonna put his stop loss below that low, right? So that's gonna become sell stops, and market eventually gonna take those out. Now, why market hunt for these old highs and old lows? Because big players or the smart money that we say in ICT terms need these orders to either reverse the market or continue going to that certain direction. Because they're not trading with $1,000 or maybe 10 grand, 100 grand. They're trading with billions of dollars or maybe even more. So they need these huge orders to get into the market, right? And that's why you see price is always hunting for these old highs and old lows. All right, so enough of this diagram explanation. I think you get the point, and let's get into the chart so it becomes more clear, easier for you to understand. All right, let's see some example. So here you on the chart you can see these swing highs have buy stops above them. We have some more here. These swing highs have buy stops above them also. And then we have these lows where there are sell stops below those lows. Alright. Same goes for these lows. Sell stops below these lows. Same goes for these lows. Sell stops below these lows. Now in this price action we were bearish, so price pretty much was looking for sell stops only, if you want to say. The bias was bearish, that's why price was hunting for the sell stops only. All right, even if it took out any sort of buy stop, then that would possibly for the manipulation. So you could see sell stops taken out. Again, those who went long here, same thing goes for that, took them out. Again, sell stops below these lows, price went through that. And yeah, pretty much you can understand what where liquidity resides just by watching these. And let me just give you one more example. Same thing goes here. We in this price action we were bullish, so price was looking for buy side liquidities. You could see swing highs ran through, swing highs ran through, swing highs ran through. So I think you get the point, right? And now we'll talk about high risk on liquidity runs and low risk and liquidity runs. All right. Let me just take this all off for a moment. Right. Like there are different explanation for high risk and liquidity runs and low risk and liquidity runs. There are so many different explanation. So for me, what I use is that high risk and liquidity runs means we we're gonna take some pullbacks to the opposing bias in the marketplace. Like for instance, from this point, like that, That is bullshit, man. Let me just give you a clear picture what I'm trying to say. Alright, so for this instance right here, for this instance here, say that we were bullish from this part here, right? So this part here we were bullish, right? So what I'm gonna see is that all the downside move here was high risk on liquidity ones for me. Why? Because price is looking for some buy side to be taken out. It's in a bullish direction. So all those bearish movement gonna be manipulation for traders, and those gonna be real slow. And I'm gonna show you some example of that. And same goes for um, sell side of the curve. Think that say that we were bearish within this part of the price range, and every move up were high risk and liquidity run, or could be some pullback into some premium PDRA, and this part here, this downside movement could be some pullback into some discount PDRA, right? So let's get into the chart and show you what I'm talking about. Now let's go to the daily time frame so that you can understand these very well. So what I like to do is that whenever I trade some pairs, I use the correlated pair, all right? So on this price action right here, from here to here, look what was GBP USD was doing, right? So GBP USD made a higher low while DXY made a higher high. What does it mean? It means GBP failed to go lower, then probably we're gonna swing the swing high that we created recently, and you could see we already have taken out that swing high and tapped into some premium PDRA. Tap into that premium PDRA, right? This fair value gap. Now, also one thing I want to say, this whole move to into that PDRA right here, for me, that is a high risk on liquidity run within this low risk on liquidity run to that buy side. And why I say that? Because on the monthly or weekly time frame, I'm bearish. I'm looking for these lows to be taken out. All right. So every move higher on the daily time frame is high risk on liquidity run for me. But on the daily time frame, only this move right here is low risk on liquidity run for me. All right. Now I'm telling it again, there are many differences between high risk and liquidity runs and low risk and liquidity runs, but the only thing that's going to help you is to identify, is to know where price is going to go. All right. So this price action right here, this portion of price was low risk and liquidity run for me. We had SM2DX, so we tap into a 4-hour um, discount PDRA, and you could see eventually price went into that buy side and tap into that premium PDRA. All right, so I'm only going to explain this portion of price right here, so make sure to listen carefully. All right, what you can see on this price action right here, we have multiple highs stacked up here on the sell side of the curve, and we have this sell stop been taken out with this move down here into that discount period on the 4-hour time frame. All right, so now because we know this, there's going to be upside movement right here from here to here into that premium period and through that high. What are we going to take this as? We take this as an obvious move. So right, we take this as an obvious move, so that's because that is our low risk and liquidity runs. All right, now every pullback we're gonna take here within this price leg right here gonna be our high risk and liquidity runs. All right, every down movement gonna be high risk and liquidity runs. Every down movement gonna be high risk and liquidity runs. Down movement, high risk and liquidity runs. All right, so you could see, although we have taken out that but it failed to take out that high that low right there. That is our longer term low, long-term low, right? That is our long-term low into that PD area, and we took out that low. So this right here was a pullback into that PD area once again. Was a pullback into the PD area once again, because we are looking for bullish prices until we reach there. All right. Then we have another pullback here, small pullback. We created high as we ran through. Then we created high again here, ran through. Then created high, ran through. We have multiple highs here as well, ran through. And then I think we had some news uh, at this time on 26th November. All right. So there was the lowest pullback into this order block right here on the 1 hour time frame. So that was our last pullback, and eventually price went up there. All right. Now, now I think you understand what low risk and liquidity runs and high risk and liquidity runs looks like. All right. Remember, I told you this is our low risk and liquidity runs. This price portion right here is our low risk and liquidity runs. But in a more bigger time frame, that is our high risk and liquidity runs. So there's high risk and liquidity runs within low risk and liquidity runs, and there's low risk and liquidity runs within high risk and liquidity runs. So you get the point, I guess. But now I'm gonna just give you a quick example how you can use this on your chart, how you can use these liquidities on your charts. All right. So I'm gonna explain that with this price action right here. All right. So on the 4 hour time frame, when we have taken out that low right there, and we tap into that 4 hour order block, and you could see there were some nice price movement from there. So that was your long term low, right? That was your long term low, right? And from there, what do you see? Yeah, you see this imbalance right here, and why I mark that swing high. When price went through that imbalance and from that swing high, we take that as a long term high. My bad, chat. We take that as an intermediate term high. Now let's turn on the session indicators. All right, so here you're gonna see a even more clear picture. So on Monday we opened up through the open here. That is also your weekly open. All right, so I'm not gonna count in the Monday's price action because we didn't broke that intermediate term high on Monday. We broke that on Tuesday. All right. So on Tuesday, when we broke the intermediate term high, what do you think gonna happen? All right. What do you think? The fact that is price has broken that intermediate term high. Now we can confirm that our bias is correct and price is more likely to go up there and see these highs and tap into that fair value gap. All right. So once price broke that intermediate term high, we go into a lower time frame. Let's say we use the 50-minute time frame. All right. Now what do you see here? You could see we broke the intermediate term high with this move right here from this low to this high. With this move, we broke that intermediate term high. All right. Let me put on something there. That's swing high right there, and this swing low right here. These are the 2 points that we're gonna use for our entry. And you could say that this is our dealing range, right? Swing low and that swing high. That's our dealing range. So we want to wait for price to tap below 50% of that dealing range. It means we want to see price tapping into discount before pushing upwards. All right. So if we take the fib and put on 50% of that dealing range, you could see during the London session we went below the 50% and tapped into a fair value gap, bullish fair value gap. and went higher. Same thing happened during the New York session. We tapped into that fair value gap one more time, and you could see price went higher again. If I would have missed this move right here, I would have taken this trade right here at 7:50 at 7 a.m. All right, because for Forex 7 a.m. to 10 a.m. is our New York session candle zone. So I would have taken this trade, but like this, targeting for that buy side, and I'm gonna put my stop loss below that low, that dealing range low. Right now, I know that loan is not gonna be taken. Why? Because that is a significant low. Because that move higher broke the intermediate term high. All right. So that low is a significant low for me, and I don't want to see price takes out that low. So I'm going to put my stop loss below that low. All right. And you could see eventually we went up and pretty much took out these highs, and that was almost like a 8-hour trade. And there were some more entries. All right, so say you've missed all these two entries right here. All right, so there were two entries for you could have taken, but say that you missed these two. All right, so and you could see we didn't sweep that high yet, so we know price is gonna take out these highs, so we still can get into that move. All right, so on Wednesday you could see we open up, took out the Asian session high, then took out the Asian sessions low, and then we have this internal range low. Now, why this right here is an internal low? Because we have this dealing range right here, and every low or and high we make within that dealing range becomes internal low or internal highs for that particular dealing range, right? So we have taken out that internal range low right here. I think we had a even for GBUSD at that time, I guess so, but we have taken out this internal range low right here. So sell side been first, then we had, I think on the 1 hour time frame, we had a fair value gap, or maybe we could have used that order block. All right, that was our order block. So we had one more thing. We had SM to DXY with that swing low and that low, and that SMT from into that 1 hour order block in discount while we're looking for buy side to be taken out. So you could say that was like the most um, obvious run higher from there. You could expect the obvious run higher from that point. You're gonna put your stop loss here below that swing low right there. That is almost like a 4-hour trade. And on the lower time frame, you could have used something else, I guess. Let me see. All right. So it had an inversion fair value gap. You could have used. Um, let me just take this. Let me just take these off. You had this inversion right here. You could have used that inversion to put a more smaller stop loss. But for me, I think stop loss below that low would have been the best place to put your stop loss and get in into somewhere within these wicks right here. This rejection block. As your rejection block, price rejected. You could have entered here. Then your loss entry was here. Alright, so within this price action, we pretty much had so many entries to take out these highs, and you could see price eventually took out those buy sides. And yeah, pretty much this was the video. I think you understand the concept about liquidity, and now you have some ideas about high risk on liquidity runs and low risk on liquidity runs. And bro, I'm saying again, it's gonna take you a lot more time to understand this, all right? But what I just shared is the easiest way to identify what low risk and liquidity run means, and what is high risk and liquidity runs, all right? And you could use these concepts to trade. And yeah, this was pretty much a good example, like how you can trade low risk and liquidity runs, all right? I hope you found this video helpful, and if you did, drop a like, leave a comment, and yeah, man, subscribe and tell me what should I cover in my next video. And I'll see you guys on to the next one. Peace out. Peace out, guys.